Okay, so picking up with part two of the recorded lecture for integrated audits, we have our third learning objective. Now, we had talked about the nature of integrated audits. We talked about manager's responsibility for reporting on internal control. Now we're going to talk about the auditor's responsibility on reporting on internal control from the PCOB. So, their objective. Okay, so we're going to look first at their overall objective. And so, we have a few things here. Again, we're conducting the audit to obtain reasonable assurance, and ultimately the report or the opinion that we're going to have to express is whether there's a material weakness or not, or whether it's effective, whether the internal controls are effective. And again, it's internal controls over financial reporting. It's not the entire COSO cube, right? Doesn't include operations, doesn't include compliance. It's just about reporting. If you remember the slice of the cube, that was in the COSO cube for reporting, and specifically for financial reporting, external financial reporting. So even within that objective for the firm, taxes and managerial reporting, we're still even a smaller chunk of that and just looking at financial reporting. The auditors collect evidence as of the date specified in management's assessment. It says here normally the last day of the company's fiscal year, but I've seen variation in that. But you are trying to match up with the management's assessment of the internal control. Okay, and so that's their overall objective. Now let's see how do they go about doing it. So the next learning objective is about their approach for analyzing internal control when doing an integrated audit. So let's look at the approach. This may be a little bit of a challenge to see. Hopefully your screen is good enough to see this. But we've got internal control. We have the control criteria, which is again usually COSO, and we have management's evaluation of control. And so when I'm auditing that, what do I need to audit? Well, I'm going to look at management's report on internal control and their assessment. And often the sequence of this is these are sometimes not necessarily following. A lot of times this management report is kind of happening off to the side, similar to the audit process, because we're doing this throughout the year, planning the engagement, using a top-down approach to identify controls to test, right? What are my significant accounts? What kind of entity level controls are there? What kind of operating unit controls are there? What kind of department level controls are there, right? Looking for issues throughout the company. But clearly, the higher up it goes, the more effect it can have, and we'll see that in just a minute. We're going to have a process to evaluate the design, and so thinking about design and then thinking about operating effectiveness, right? So design effectiveness is, again, if it was working 100% perfectly, how would that control, prevent, and detect material misstatements? Operating effectiveness is it really at 100% or is it something less, right? And so we're trying to evaluate when you actually look at the control in operation, is it actually working the way it's supposed to? Then forming your opinion and then issuing the report, right? So those are the steps. And so let's look through those in a little bit more detail. So planning the engagement, and but the thing is here, we've been talking about several of these things as we have been working through, right? And so we've talked about understanding the firm's internal control system the entire time that we have actually been talking about auditing each of those transaction cycles, right? So this is anything separate. This is part of it, right? In terms of coordinating our opinion on the financial statements and our opinion on the internal controls over the financial reporting process. And so we're looking at a lot of the similar things before in terms of the industry. How much oversight are we getting from regulators? What does their business model look like? Have they made changes or made acquisitions that would potentially impact internal control? Oops. So how is it different? Because remember, we still have our audit risk model, right? We have audit risk equals inherent risk times control risk times detection risk. Right? So we still have this piece, right? This is where we have internal control consideration in the financial statement audit. So there's a couple differences. One is the time period we're looking at. If we're talking about the opinion, right, the audit control opinion, it's as of a certain date. Okay? If we're talking about the financial statements, right, it's the entire financial statement period. So that's this part right here. Okay? So that doesn't, you're kind of like, okay, how does that make a difference? Well, if you find something throughout the year, and in terms of a control problem, and if the company fixes it before the opinion date, then it doesn't necessarily need to be included in the opinion, and you feel good about it as an auditor. Whereas if they have a problem 3 months out of the year in an internal control around a given area, it doesn't matter if they fix it before year end. You've got 3/4 of the year that operated under this elevated control risk. And because of that, you're going to have to manage your substandard procedures based on that problem being there for most of the year. Okay, and that's one of the big differences between these two is what remediation helps the opinion, but does not eliminate the control risk that was present. So this top-down approach, again, is focusing on these most important controls, or most of the controls that are going to impact the opinion, essentially, right? And so thinking back to that COSO cube, we didn't talk a lot about the different levels, and I'm not even going to attempt to draw it with this. But remember that COSO cube on that little dimension going back this way, we basically had the different levels of the firm, right? The entity, operating unit or division, department, right? All that stuff. And so when I'm thinking about the controls that have the biggest impact on the likelihood of there being a material weakness, it's the ones that are over the entire firm, right? And so these are things that are usually related to control environment or possibly monitoring, right? Those are the two pieces that are generally at the entity level, right? A lot of the control activities we spent our time on, a lot of those are lower, right? They're kind of maybe towards the back of that COSO cube. They're still important. I'm not going to say they're not important, but they may not be as pervasive as the entity level controls. So maybe you have one department that's having a problem with segregation of duties, right? Versus an entity level control where you have the audit committee is just not very effective, right? Or the internal auditors aren't very competent, right? That's the monitoring side. So those have a potential larger impact on the financial statements as a whole, right? And so even if you can't tie it to a direct impact, and maybe you could with an internal auditor, like they did some work around given areas, but audit committee may be a little bit more indirect. But the point is, those still the ones we're going to focus on when I'm thinking about the opinion, right, for my uh, internal control evaluation as the auditor. All right, so looking at kind of the overall approach here, again, at the financial statement level, we have these entity level controls we're going to look at. We identify significant accounts from there, think about the relevant assertions for those accounts, turn those into audit objectives, right, which is what we've been working on. And that's where we can do control testing here. Some of you might have been able to see some of these, and in the different transaction cycles. And actually, hopefully, all of you got to see them in the different transaction cycles we've been looking through in the different areas. Um, so here's an example, right, in terms of how this would look out. So we've got a balance sheet. We have a control around centralized processing. We're going to follow that down. Accounts receivable is one of the significant accounts. There's a completeness assertion there. And so one of the controls we might look at is this detailed list of cash receipts and how complete is that when it goes to accounts receivable, because we worry about overstatement, right, of accounts receivable, and so not having all the cash receipts posted to that account could result in an overstatement of accounts receivable. And then looking at the process, right, so we would kind of work our way down to think about what kind of process we need to evaluate and what kind of entity level controls we need to evaluate. Okay, and so then looking at some examples of entity level controls that we'd want to look at. So I'm not going to go through all these, but this is a good figure to kind of spend some time on. This is a nice little summary. So think about, I mentioned the audit committee already. I mentioned the internal audit group. Let's look at maybe another one or so, like the whistleblower program, right? So some of the frauds that we found out about in the early 2000s were because of whistleblowers, right? And because of that, there's been some protections that have been put in place for whistleblowers. And so, and some requirements, but let's say the firm had not established a program for anonymous submissions for a whistleblower. All right, that would be a control weakness. And maybe there's an inappropriate or inadequate process to actually follow up on allegations, right? So does it get assigned to someone that could be independent from the potential problem, for example, but still has enough competence? Hopefully the internal audit group would have enough competence and independence that some of those matters could be referred to the internal audit group, to the audit committee, for example. And so if those aren't operating effective, that could be entity level material weakness. Hiring and promotion, if they're not doing good enough substantive background checks, then that would be also considered entity level, because that could impact a lot of different areas of the firm, right? So those are just a couple examples, but again, there's several here that could indicate there's a significant deficiency and possibly a material weakness.